Good morning, folks, and welcome to our webinar on charitable plan giving for transferring wealth and reducing tax burden. It's May 26, 2021, and it's good to be together. It's a beautiful day in May. So this is our screenshot in which we always kind of forewarn you that the information is really information. We're not providing any type of specific guidance concerning any issues that you may have. And if you do need some specific guidance, obviously the folks here at Sachs are here for you, or consult someone else, professional tax, accounting, legal, or other competent advisors. But we hopefully are going to give you some good ideas for some planning techniques right now. This is today's presenters, myself, Todd Polinak, the lovely Marie DiCaprio, and the lovely Joy Matak. And they are going to really do the heavy lifting. I'm kind of just here to be the moderator and perhaps kind of introduce some thoughts towards the end. Today's agenda, we're going to provide an overview of the current proposals being considered in Congress that could shake up what we know about transferring wealth and tax implications, the advantages and the disadvantages of various types of charitable giving, annual cash donations, donor advised funds, in-kind donations of appreciated assets, qualified charitable distributions, also known as QCDs, and charitable trusts. And let me just say, folks, that we encourage you in the chat box to put some questions in, because we are going to have time to answer any questions you have. So in that chat box, just put down your question and hopefully we'll get a chance to answer it today. So now I'm going to turn over the presentation to my partner and friend Joy, who's going to talk about where we are and where we're going. Joy, take it away.
Thanks, Todd. So currently, the 2021 exemption is $11.7 million per person, or $23.4 million per couple. That's the amount that each taxpayer, each U.S. person can give away during their lifetime and at their death. Above that amount will be taxed at 40%. The exemption is automatically going to be reduced in 2026. And Congress is currently signaling some interest in reducing the exemption and raising the tax rates. As a result, we're thinking that 2021 could be a last chance opportunity. Could you please advance the slide? Currently, the For the 99.5% Act is being considered in Congress. This in the Senate. This would reduce the estate tax exemption from $11.7 million down to $3.5 million, so that in the aggregate, you could only give away $3.5 million, and everything over that would be taxed at a rate based on a graduated tax scale from 45% all the way up to 65% for you billionaires out there. It also effectively eliminates valuation discounts in most situations. Valuation discounts are those reductions in value for gift tax purposes that we apply in cases where you're transferring a fractional interest in property. There are also technical changes that will reduce the efficacy of planning techniques, such as grantor-type trusts and grantor-retained annuity trusts, which we are concerned may really rock the foundation of traditional estate tax planning. Additionally, the For the 99.5% Act forces tax changes on assets and trusts after 50 years, and that's going to require some special action in contrast to current law, which would allow those trusts to continue forever, depending upon your state law, without being subject to a transfer tax. Please advance the slide. Additionally, there are some deemed realization proposals that have been proposed in both the House and the Senate. Under these bills, a death event on death, that will be a recognition event, and all of the assets that an individual owns will be treated as having been sold for income tax purposes, and the transferor, in this case the estate, will recognize gain. This is very similar to the Canadian system, where there would be an immediate recognition event on death. Now, the president has also talked about elimination of the step up in basis rule, which would allow assets to be stepped up to the date of death value so that there would be no gain on a transaction involving a sale of an asset inherited from someone. That is what the president has been talking about, but we haven't seen any detailed information about how that might be put into effect. The fear is that these deemed realization proposals might be the closest thing that we can rely upon as far as the form of those that legislation might take. So what would happen? Unrealized capital gains would be taxed at the moment of death, except for certain exemptions. Under the STEP Act, which is the Senate proposal, the first $100,000 would be exempt from tax. The House version of that bill would allow for $1 million exemption. Both of these amounts are indexed for inflation. The legislation is expected to allow taxpayers to pay an installment depending upon which bill is passed. There would be a deduction against estate taxes. So these deemed realization proposals are being considered to be in addition to an estate tax, not instead of an estate tax. And the capital gains tax could be offset by any estate taxes that would be paid. This is probably the most concerning provision of the STEP Act, that's the Senate version, is that it's retroactive to transfers that are made after December 31st, 2020. So in other words, anything that might have been transferred during 2021 could be deemed to have been a realization event. And that includes transfers to grantor type trusts. So these provisions are pretty scary for those of you who might be considering estate planning, and they really have prompted people to do some planning around these proposals. Could you please advance the slide? No one knows exactly what might happen this year, but tax reform is very likely. There's been increased spending due to the pandemic. We just saw a $1.9 trillion relief package that was passed by both the House and the Senate. There is the political will to spend additional funds, more stimulus going out, and they're looking for ways to pay for it. Ultimately, we're advising people to prepare for the worst and hope for the best. But it is important to act with caution and make sure that you're relying on your trusted advisors for the best advice. And with that, I will turn it over to my colleague and friend, Marie DiCaprio.
Thank you, Joy. So I think the first thing that you really want to do when you're thinking about doing charitable planning is talk to your trusted advisor. Your trusted advisor is a person who really knows so much about your life and your financial situation and really knows what goals you're trying to accomplish. Then your trusted advisor, depending on who that person is, whether it's your financial advisor or your accountant or an attorney, can really pull in some of the other disciplines so that we make sure with every decision that we're contemplating, we are looking at every aspect of that decision and how it affects everything else. So there would be tax implications of the charitable planning. There are estate tax implications. There are investment implications and investment strategy. And there are also implications for some of the other beneficiaries of your estate. So you do want to make sure that there is a collaboration between all of the disciplines so that any decision that you're making with regard to charitable planning makes sense from all fronts. As I like to say, we don't want to upset the apple cart by one decision that we're making. We want to make sure that everything is really working together, making sure it achieves your goals, as well as giving you perhaps other tax and estate planning benefits. So I think that's super important to always check back in with your trusted advisor. Let's go to the next slide. So today we're going to talk about a number of different strategies The ones in bold are the ones we're going to talk about. We're going to discuss annual cash donations, donor advised funds, in-kind donations of appreciated assets. We're going to talk about QCDs. We will not talk about today testamentary bequests or charitable annuities, but do know that those are two other strategies that can be used in charitable planning. And then we'll round back to Joy, who will get in detail on charitable trusts. So really the simplest way to make a charitable donation, which I think most people are accustomed to, is just making a cash donation. You know, writing out a check to your favorite charity, pretty straightforward. You basically, you know, decide how much you want to give, write out the check, send it to the charity. They generally send back, you know, some kind of thank you note or receipt that they received the donation. And then from there, what the donor's job is really to do is to keep track of all that, so that when it comes time to do your taxes, you then have the backup for all of the charitable donations that you've taken for the year. So we need to have, you know, substantiated donations. So if you are, you know, more charitably inclined and you like to give to a lot of different organizations, this may be a little bit of a record keeping challenge, because you do have to keep track of all those thank you notes and cancel checks and those types of things to be able to then turn it over to your tax preparer to get that charitable deduction. It's very easy to do, obviously. I mean, you just, cash is king, basically. It's easy to give money, and for most, if not all nonprofits, they have a need for cash. So that works out perfectly. Generally speaking, your donation is deductible up to 60% of your adjusted gross income, and that is through 2025. However, for 2020 and 2021, that amount has been increased to 100% of adjusted gross income. So really, because of COVID and the glaring need for so many people and organizations that were lacking during the time of COVID, this restriction was lifted to really encourage and benefit those people who were being more charitable. I think that what, you know, so many of us realized through COVID is just the huge need between, and the difference between the haves and the have-nots. And so many more people, you know, even just anecdotally, more people that I work with, clients that I work with, the tendency is just feeling like they want to be more charitable, using their wealth, using their money for good in the world, and just the realization that there are so many people, you know, that they were just so grateful for all that they had during this terrible time for the world, and for all those people who really didn't have, you know, the same kinds of resources. So it just highlighted how important it is, and how, you know, every dollar that filters through to charities is so important, not only in great times of need like a global pandemic, but really all the time. So that's why this deductible amount was lifted for last year and this year, to really encourage those donations. From the planning perspective, I mean, annual cash donations are fantastic, but we could be missing opportunities for larger income tax deductions and estate planning. So that's one of the reasons why, you know, we may want to take it to the next level when thinking about charitable planning, because there could be other beneficial strategies for the donor. And from the charity's perspective, you know, while cash donations are fantastic, it's very hard for them from year to year to really plan for when they're going to get those donations and how much they're going to be. So certainly if there's a charity that you feel very passionate about, you may want to think about doing some kind of planned giving, or have it part of your estate plan, so that they know and can plan on, you know, a certain amount of dollars per year. It certainly helps them with their planning and growth, and what their mission is. Let's go to the next slide, please. So another way to do charitable planning, which sort of simplifies the cash donation process, is using donor-advised funds. So a donor-advised fund is a bona fide charity, a 501c3 foundation. And the way it works is the donor makes a contribution to the donor-advised fund, and that is the one-time tax-deductible contribution for that year. Then the donor advised fund will make grants to the specific charities on your behalf, which you designate. So what's nice about this is rather than, let's say there's 10 charities that you feel passionate about that you want to be giving to, rather than sending money to those 10 charities and having to, again, keep track of how much you gave and who you gave it to and getting those receipts back and having that all ready for your tax preparer, what you do is you make the one contribution, you get the receipt for that, that flows through to your tax return, and then you are able to make the grants to the individual charities at any time. It doesn't even have to be within that year. It could be throughout your lifetime. So one of the situations where using a donor advised fund is extremely beneficial is, let's say you have a job where in 1 or 2 years you know you're going to get a significant bonus, or your income is going to be much higher than it's been in other years, and you may want to make larger charitable contributions in those years to get the larger tax deduction, but then make the grants to the charities. Basically, you could do it over your lifetime. And not only can you do it over your lifetime, but the donor advised fund allows you to create a legacy in that when you pass away, you can designate a successor who will then continue to give away the money that's in your donor advised fund as long as the money is still there until the money runs out. So it's really a lovely way to not only be creating a lifetime of giving, but also potentially, a legacy of giving as well. The donor advised funds do accept cash, but they also accept highly appreciated securities, which we're going to talk about next, and in some cases, privately held investments also. So again, when thinking about your overall planning, if you're a business owner, if you're a business owner and you're going to sell a business, I mean, there's a lot of different strategies that really can be used to help you in getting the tax deduction as well as meeting your charitable goals. Let's go to the next. So the one strategy that I think is very popular, I think mostly amongst my clients, is transferring of what we call low basis stock. So many of us have stocks that were gifted to us, many years ago, or we inherited from somewhere, or we just bought, again, many, many years ago, without never really knowing how much we paid for that stock or what the gift value was when we received it. And so this type of stock becomes kind of tricky if you want to turn around and sell it, because one, you may not know what you bought it for, what your acquisition price is in order to calculate a capital gain, or two, it may be a stock that you have a huge amount of appreciation in, and if selling it, you would incur a large capital gains tax. So one of the nice things is being able to transfer this stock, gift this type of stock to a charity. And when you do that, you do not have to sell the stock and recognize that gain. So this is a wonderful strategy for people who are looking to minimize capital gains, be able to take that tax deduction. So, again, for 2021, the deduction is up to 100% of AGI, 100% of your fair market value. Normally, the deduction is limited to 30%. If that exceeds your AG, if the value of the donation exceeds your AGI, you can actually carry forward the deduction for 5 years. So we have, a little less to worry about timing. And what's really great is, again, once the charity receives the shares, they don't necessarily, it doesn't matter to them. They don't necessarily have to keep it. They can sell it. There's no tax ramifications for the charity. Now, if you are a nonprofit receiving or looking to receive these kinds of in-kind stock donations, there's really two things that you need. One, you need to have a brokerage account that can receive these shares. So a bank account generally doesn't work. You need to have a brokerage account that can hold shares. And secondly, you really need to have a board policy of how to handle these stock donations. You know, will you keep it? Will you sell it? Will you, what are you going to, which account will it go into if you do sell it? So these are the things that are important from whether you're the donor or the receiver of the stocks. Another thing I think why this is coming to light now is the potential that the step-up basis on death could potentially be eliminated or changed in the future. So if that's the case, many times people hang on to low basis or no basis stock and say, well, because currently when you pass away, all of that gets what's called a step up in basis. So the cost basis becomes the value on the date of death. So all of that gain that would have potentially been taken now basically just goes away. But if that gets changed, then the willingness to hang on to stock, these types of stock forever, sort of goes away. And it might be a good idea to be using this stock to give to charity. It's also a great thing for people who, bought stock. Maybe you bought, a bunch of shares of Apple stock, 20 years ago or even 10 years ago, and the price has appreciated so much. And now when you look at your portfolio, it's a huge percentage of your overall portfolio. Well, this is a great way to reduce exposure to that one stock without having to incur any capital gain. So here again, just in this one situation, we're looking at so many different angles, the investment angle, the estate planning angle, the income tax angle, just, from doing this kind of thing. So again, going back to why it's so important to engage your advisors. Let's go to the next page. So this is a fairly new strategy, qualified charitable distributions. Just taking a little step back, for those of you who may not know, you may be contributing to your 401ks and your IRAs through your lifetime, but once you hit a certain age, and right now that age is 72, you actually have to start taking distributions out of those retirement accounts. And those distributions are called the required minimum distribution. And there's a very specific formula where that amount is calculated, and you have to take that out every year, whether you need that money or not, because the IRS wants their tax money. And when you take that distribution, it flows through on your tax return as income. So what the QCD allows you to do is take money directly out of your IRA, going directly to a charity as a charitable contribution. What happens at that point is the money that is the QCD does not flow through to your tax return as income. You don't get the deduction, but you don't have that additional income. So, it's not hard to really build up a pretty large IRA by the time you're 72, where you might have a pretty substantial required minimum distribution. So this is a fantastic way to give to charity and not have to recognize that income on your tax return. You can do up to $100,000, and you have to be at least 70 and a half and older. So if somehow, you're in your 50s or 60s and you have an inherited IRA, this strategy will not work for you. You have to be 70 and a half. But if you do have an inherited IRA at that age, you can still do the QCD. It's just the age requirement. It does qualify, as I said, for the required minimum distribution. It has to go directly from the IRA to the charity. So most custodians these days know how to handle the qualified charitable distribution, and they all have their procedures for how to do that. You usually designate who the charity is, and then they'll make out a check from your IRA. It gets sent to you, and then you forward it to the charity to make sure that it goes to the right place. One thing that I will note is when you get your, just one thing to be aware of, and again, why you would want to let your tax preparer know that you've done a QCD if you have, is because when the tax forms, the 1099s come out, generally speaking, and as of, the tax forms that came out this year for 2020, the custodian does not break out from the distribution how much is a QCD and how much actually went to you. So you have to make sure you let your tax preparer know that you did this. So the other great thing is that there's no subjectivity to AGI limits. So if you have 100,000 in your IRA and you wanted to give it away, that's perfectly fine because you're not getting the charitable deduction. You're basically, that income is not flowing through to your tax return. The only one thing is you can't donate that QCD to a foundation or a donor advised fund. It has to go to an individual charity, a 501c3. And here again, you can also donate. You can donate cash, or you can donate stocks or other investments that are inside of your IRA. But usually we do cash because generally the way the custodians work is they're sending out a check. So it's generally cash, and selling investments within an IRA, there's no tax consequences for the owner of that IRA. Let's go to the next. So now I'm going to turn it back to Joy, who's going to talk about advanced charitable planning.
Thanks so much, Marie. So advanced charitable planning. I could spend the whole hour talking about this. I'm very passionate about using charitable trusts as part of a comprehensive estate plan, but they only gave me like 25 minutes. So what I thought I would do is just kind of give you a brief overview of the two different types of charitable trusts that we like to use as part of estate planning, and then really narrow down on one of the strategies that I think works best in our current planning environment. So the way that a charitable trust works is by essentially separating the interest that one owns in a piece of property based on time. So whereas you might be thinking of, it's almost like a pie, right? Where you have a pie and you cut it into various pieces and you give pieces of the pie away. Those are slices. In this case, it would be more like cutting the pie horizontally so that you gave the crust to one person and the rest of the pie to someone else. In this case, it is the current interest, which is going to be measured either in a term of years or based on lifetime of a non-charitable beneficiary, and then a future interest, which is whatever's left over. So it's that crust part, which is the term of years or lifetime of the non-charitable beneficiary, and then all of the filling and the rest of it that winds up going to the other beneficiary. So the two different types of charitable trusts split these current and future interests in different ways. A charitable remainder trust, which just like the title would imply, is that the current interest, or in my hypothetical, or my what is it called? It's a whatever, my hypothetical, where you would take the crust and you would contribute that to the non-charitable beneficiary, the individual that you were trying to benefit. And then the remainder, that would be the balance, that would go out to the charity. So that's how a charitable remainder trust works. A charitable lead trust, rather, would give the lead interest, the current interest, to the charity, and whatever's remaining would either come back to the donor, the original person who put the asset in, or to another non-charitable beneficiary. So that is how the two different types of trusts work. A charitable remainder beneficiary, the charity's got to wait until the end of the current interest holder's ownership. And the charitable lead trust, you would give it to the charity first, and then at the end it would go to the non-charitable individual or beneficiary. Could you advance the slide, please? Under the current planning environment, the zeroed out non-grantor charitable lead trust may be one of the best vehicles that people can use if they have charitable intent and they're looking to get some estate planning benefits from it. A non-grantor charitable lead trust works so that you essentially take an asset that is an income producing asset and you put it into this trust, thereby taking that asset out of your estate for a period of time, for a term of years. And by doing that, you remove the income that is generated from that income producing asset from your personal income tax return. So if you think about it, if you have an asset that generates maybe a portfolio that generates $100,000 a year, by putting that portfolio into this trust, you would no longer have that $100,000 a year of income on reporting on your personal tax return. Of course, also by putting it into this type of vehicle, you would also not have access to the portfolio or to the income earned. So you really do have to be thinking through whether this type of transaction makes sense for you. There would be no deduction to the donor under this scenario, under using this type of vehicle, other than the exclusion of the income assigned to the trust. So you wouldn't get an additional deduction for the value that the charity is getting, other than excluding that income that is earned. In the hypothetical that I just presented, I'm putting a portfolio in, and I am essentially removing the $100,000 of income that is earned on that portfolio for the duration of the lead interest. And instead, that $100,000 is going to get paid to a charity. The trust is going to get an annual deduction for the amounts paid to the charity because the trust will be its own taxpayer. It allows people to remove an asset from the estate that will grow faster than the current 75/20 rates. Okay, so let's just step back for a second. And I just want you to know I'm literally in my office and I've just stepped back just so that I could take widen the aperture and really look at this. So why am I talking about 75/20 rates? It's so technical. Because there are very specific rules that govern charitable lead trusts. So, this is not one of those kind of things that you can just Google and get a form off the internet and do it yourself. Please don't do that. Please go talk to your trusted advisor and talk about whether a non-grantor charitable lead trust is right for you. So the current 75/20 rates in May of 2021 is 1.2%. So if you've got an asset that will grow faster than that 1.2% per year, then that is a good asset to put into a non-charitable lead, non-grantor charitable lead trust, because it will allow any of that appreciation over that 75/20 rate to go to the people who are going to be the non-charitable beneficiaries at the end of the term of years. So let's look at an example. Can you please turn to next slide, please? Okay. In our example, Artemis owns a stock portfolio worth $10 million. He expects that this asset will continue to grow at a rate of 5.5% annually, generating about $550,000 of taxable income to Artemis. Okay, now by way of disclaimer, I am not a financial advisor. I rely heavily on my colleague Marie for this kind of advice. I did not consult with her when I put this example together, so I don't know whether this seems practical to me. But that again, you'll have to talk to your trusted advisor about whether this strategy could work for you. But anyway, for the purposes of keeping it simple and trying to explain how this works, Artemis establishes a 20-year CLAT and funds it with the portfolio. So essentially moves the $10 million into the non-grantor charitable lead trust and then sets it up so that the income that gets earned winds up going out to the qualified charity in an amount determined based on current interest rates. Assuming that this CLAT is properly administered and that interest rates are lower than expected growth, and that's what we're expecting because the interest rates currently are the 75/20 rate currently is 1.2%, and the expected growth is substantially higher, then this should result in a transfer to non-charitable beneficiaries at the end of the initial term, at the end of the 20 years, that will be worth more than the original $10 million portfolio. So what was done here? Artemis moved the $10 million of value into a trust and removed $550,000 of taxable income, approximately, from his current income tax liability on an annual basis for 20 years. So he removed 550, he basically cut his adjusted gross income by the $550,000 for 20 years. At the end of the 20 years, the balance goes out to his children, and what's remaining in the trust winds up being higher than the original $10 million of value put into the trust. And because it was structured the way that it was, the non-charitable transfer, the gift that winds up being, for gift tax purposes, is actually going to be zero. So Artemis is able to remove an asset from his estate, from his taxable estate during his lifetime, that's generating $550,000 of taxable income, and he's able to move out over $10 million worth of assets to his family at the end without using any gift tax dollars. Again, this is a complicated scenario, and you really do need to consult with your trusted advisor. So here's some general thoughts about charitable trusts and how they work. Charitable trusts can be set up as lifetime transfers or by operation of will, testamentary transfers. There will be an income tax deduction for charitable contributions through charitable trusts, but they're going to be limited. The value, you'll either get a charitable contribution deduction, and this depends on the type of vehicle, whether you're going to be removing income from your taxable income, or whether you're going to be structuring it in some different way so that you get a current actual charitable deduction. And that is going to be limited to the value of the actual interest being conveyed to the charity. So that's the amount that the charity gets, less whatever you retain or whatever you give to other beneficiaries who are non-charitable. And the deductions are also going to be limited. Generally speaking, when you make a contribution to a charitable trust, you're going to be limited to 30% of adjusted gross income. Lifetime transfers are usually going to provide greater tax benefits than testamentary bequests, because the donor, that's the person who's transferring the asset, will receive both an income tax and a gift tax charitable deduction. So the way the gift tax charitable deduction works is when I make a transfer to a charity, but I keep an interest, then I'm going to reduce the value of what goes out to the charity by whatever I kept or gave to a non-charitable person. That gift to the non-charitable person will be less than what the total value. So in the case of the Artemis example, he put $10 million into a non-grantor charitable lead trust with the expectation that more than that will wind up going to his beneficiaries. But because of the way all of the tables and calculations work, it winds up being a zero gift. And with that, I'm going to turn it over to Todd to see if anybody has any questions.
Thanks, Joy. So a few questions we got in, and just wanted to let people know. I know one of the questions was, what about the slides? Where are the slides? Well, we are going to be distributing these slides and also the recording. I believe it's usually 24 hours after the webinar. So stay tuned. We will definitely be doing that. And also, just from looking at these questions, and forgive me, but I'm trying to read very tiny print here. Can the charitable lead trust annuity payments be made to private foundations and donor advised funds? Joy.
Yes, the answer is they can be. They do not have to be made to outright to a qualified charity. And this can be really beneficial for the donor because it really allows the donor to retain some measure of control as to how those distributions are going to be made to or for a charitable purpose.
The ability to deduct 100% of AGI applies to cash only in 2021, Marie? Or Joy?
Okay, so no, it does not apply only to cash, but it's going to apply only to assets that can be, easily liquidated. So you would still be able to use the strategy that Marie had talked about earlier, the gift of appreciated stock, and qualify for the 100% AGI, the charitable contribution up to 100% of adjusted gross income.
Why would someone set up a charitable remainder trust is another question.
Okay, so let's just backtrack a second to talk about what the charitable remainder trust is. Whereas the charitable lead trust gives the interest to the charity first and then the non-charitable beneficiary at the end, a charitable remainder trust retains the interest for the donor or for the non-charitable beneficiary, and then at the end, the balance would go to the charity. So in this case, if you think back to my pie example, the crust is retained by the donor or the non-charitable beneficiary, and the filling and the bottom winds up going to the charity. So a charitable remainder trust is a great strategy in two situations. One, it can be used when you know you're going to be selling a business, but you haven't actually executed the sales agreement yet. And why would that be? Well, because a charitable remainder trust is treated as a charity and is subject to the charity's income tax rules, which means that the charitable remainder trust is not actually going to have a recognition event on the sale of that business. So you can actually defer the capital gains tax on the sale of a business interest or other asset by transferring it first to a charitable remainder trust and then selling the property. The event happens, there's no recognition at the charitable remainder trust level, and distributions are made back to you as the donor or to a non-charitable beneficiary. And it's only as those distributions are made that you will recognize gain up to the amount that's actually being distributed. So it creates a deferral of that capital gain over a term of years. And generally what I see with that, when that strategy is employed, is that the charitable remainder trust will be for the life expectancy or the lifetime of the donor. In that case, they would retain it so that there wouldn't be a gift element necessarily, but rather it would just be something that would be extended over their lifetime. And I just want to note that if you are interested in selling a closely held business, using the charitable remainder trust strategy, it could not be an S corporation. S corporations cannot be owned by charitable remainder trusts. The other situation that's been talked about a lot since the Secure Act was enacted back at the end of 2018, 2019, doesn't matter, Secure Act was enacted, is possibly using the charitable remainder trust as a beneficiary of an IRA, so that instead of requiring distributions within 10 years to a designated beneficiary, the charitable remainder trust could immediately liquidate the IRA, which of course would not be a recognition event because the charitable remainder trust is considered a charity for income tax purposes, and then spreading the distributions out to the beneficiary over time, thereby getting you a stretch using a charitable remainder trust. Now, there are certain, you really do have to do an analysis of whether you're going to get an income tax or a tax benefit by using a charitable remainder trust as a beneficiary of an IRA. So again, you've got to consult with your trusted advisors and make sure that you're working with people who understand these different structures and can put together the right plan for you and for your family.
Okay, another question is, will my contribution to a GoFundMe cause qualify as a charitable deduction. Marie?
No, actually, for the most part, it will not. So you have to make a contribution to a bona fide charity, a 501c3 public charity, or a public foundation to get that tax deduction. While you may be doing a great deed, a great service by contributing to the various Gofundme efforts that are out there, generally speaking, they are not going to qualify for a tax deduction. So do be careful. If you do want to be able to get that tax deduction of who you're contributing, what you're contributing to.
Yeah, and I would also add that you want to be careful using GoFundMe to make those kinds of transfers because they are considered gifts under the tax code. So unless they qualify, unless you have enough donees to qualify for the annual exclusion, or it's under the annual exclusion amount, which is $15,000 per donor per donee. So in other words, Todd, you could make a transfer of $15,000 to me and to Marie, but if you gave either of us more than that $15,000, you would be considered to have been making a taxable gift that would be deducted against your lifetime exemption. And Marie and I will be expecting our checks after this call.
I think that my wife would not approve, but.
Oh, well, you have a wife. You can actually give us each $30,000, just not $30,100.
Right. So I know there's some not-for-profits on the line too. What are some best practices for a nonprofit who's interested in starting a planned giving program? Any thoughts on that?
Well, again, your trusted advisor team is going to be really crucial in this case. You want to make sure that you have your team assembled, that they're aware of what you're doing, that they make sure that you've got documents in place, that there's a board of directors that's making decisions as far as how those how contributions received are being spent, and that you're following all rules and regulations governing charities.
Okay, looks like there's one last one. Can you do a QCD to a donor advised fund? I don't know, Marie, did you address that? I don't remember.
I did, but I think it's an important thing to review. You cannot do a QCD to a donor advised fund. It has to be to a QCD has to go out to individual charities. So while it seems like it would make sense that you'd be able to do, you know, up to 100,000 to a donor advised fund, which is in itself a 501c3. In fact, the way the rules are structured is that you cannot do that. It has to go out to individual charities, and it must go directly from your IRA. So you cannot take possession of the money and then write the check out to the charity. It has to come from your IRA to the charity. Most custodians out there do know how to work through these procedures now, and it is doable. It can be a little cumbersome, but still very much doable. So I do encourage people who are charitably inclined, especially those of you who have very large required minimum distributions, to look into that because it is well worth it.
Okay, I think that's it for questions. There's no more questions that came through, so we can probably close out the webinar. And just wanted to thank everyone for participating today. Thank you, Marie and Joy, and sorry, no checks coming to you from me. But
thank you anyway, Todd.
No $15,000 or $30,000 checks, but do appreciate your participation. Be looking forward to our future webinars. You know that you can always get in touch with us on our website, and we will be sending out this presentation with the slides. I think it's 24 hours after the presentation, so you have our contact information as well. So have a great day. Enjoy this beautiful May day, and we will talk to you really soon. Take care, folks.